Hello, I'm Andy Murray, the Executive Director of the Major Projects Association. It's a pleasure to welcome everyone to another one of our podcasts following a really interesting seminar that we had on making projects investable. I'm currently joined by James Stewart and Paul Innes. James chaired our session and Paul was one of our speakers. So I'll ask them to do a very quick introduction before I kick off in terms of what we'd like to discuss on this podcast. So James, welcome. Please say who you are, where you're from, and what a bit about your background.
So James Stewart, I think I wear a few hats at the moment, but I'll pick Senior Advisor of Agilia Infrastructure Partners for today. And I have a long history in infrastructure, both Chief Exec of PUK and IUK, and also Global Chair of KPMG's infrastructure business.
Great, and that's Partnerships UK and Infrastructure UK
That's
in terms
right.
of the PUK and IUK. So hence with that almost perfect background for a chair of our event on making projects investable. So thank you for doing that on the day, James, and following up with this podcast. Paul, same question to you. Where are you from?
Thanks,
who are you? Background?
Good morning, everybody. Paul Innes, I'm a director in Grant Thornton's Business Risk Services team. I look after our project and programme assurance service line, and with one of my other hats on, I'm a high risk review team leader for the Infrastructure and Projects Authority.
Great, and Paul, you sort of took us through the world of risk in terms of its impact on project investment appeal, so we'll come back onto that in a moment. But I'll just do a quick recap in terms of why we had a seminar on making projects investable. It was a member request, so every year we go out to members, ask for topics of things that we would like to do a deep dive into, and we had numerous requests that can we revisit how to make projects more investable. But rather than talking about project finance in general, we were asking the question, well, how can we set that up and establish things in a way that makes them more appealing, and therefore more likely to attract the investment that they need. And this was in the context of, I think we had it in your opening, James, of around sort of a £1 trillion worth of projects, whether that's infrastructure that the UK requires, whether that's industrial facilities or real estate. But we know that there's a big pipeline of some quite significant projects and developments in the UK. We also know with current economic context that funding for those isn't all going to come from the Treasury, from the Exchequer. So we need to be looking for other forms of finance to be able to pay for these projects. I think we had a bit of context as well ahead of the seminar in terms of the amount of finance that is available in terms of the pension pools, for example, in the UK and also elsewhere, and the sort of the increasing size of the sort of green finance schemes that have been set up. But we had a great reference around that, money is global and therefore it will find the best projects anywhere in the world. So with a UK orientation, we were thinking about how do we set up our UK projects to secure that finance. So James, if I come to you first, in your introduction, you gave us a great run through sort of the history of different sort of approaches to financing projects, and you sort of set out sort of 5 different aspects as well in doing so. One is around those particular models that we use. Second point, that UK is very different to the rest of the world. There's a significant role of government in terms of supporting those schemes and defining those schemes, and ultimately that the government is the final sponsor, because they're the ultimate recipients of the sort of economic benefits from such schemes. And you also reflected that, but actually in the UK we do lack a domestic sponsor, so the likes of an EDF or Hitachi that would put the schemes together in other parts of the world. So I thought, to ease us in to the discussion, James, perhaps you could just remind us of what those sort of different contractual models are and how they've sort of evolved over time.
Yeah, because I mean, to me, whether a project's investable is so inextricably linked to the contractual model. And when I thought about it, I was just sort of amazed at the journey the UK has been on. So I think pre-1980s, it was all public sector, really, public sector owned. Then we had the privatisation programme, where the majority of the utilities, and this I think is where the UK differs from many other countries in the world, but the majority of the utilities became privatized, subject to regulation, and very successful model in my view. The ability of those regulated utilities to raise a lot of capital, 10 billion a year, I think on average, at a very low cost. Then the 90s heralded the PFI initiative, which really dominated all the infrastructure that fell outside those regulated utilities. I think driven by a lack of trust in the public sector to deliver the massive investment the government wanted to make, off-balance sheet treatment in those early days, and that really dominated for 10 years, and it heralded really the start of the project finance market in the UK. We start off in the early days with 18-year debt, the emergence of the infrastructure funds, and then we gravitated to 25 and even 30-year debt as the market matured. And then, of course, as PFI, I'm going to say, went out of fashion for various reasons. And now we really have a very mixed economy of contractual models. The big deals have gone back to the state. So HS2, Crossrail, the state is the dominant sponsor and investor, really, provider of funds. We've had the emergence of the hybrid RAB model for Thames Tideway and New Nuclear, which I think is a very successful model, again, recognizing that those big projects are too big for the normal RAB model, and the government has to take some of the more extreme risks. We've got a sort of myriad of other structures, OFTOs, local authority development schemes, and I could go through a lot more. So yeah, a real evolution. I think that's why and I think that's one of the reasons why actually the UK is such an interesting market for international people, because we've sort of tried and done a lot and seen the good, bad, and the ugly.
And there's a lot of sort of ingenuity in those different models to try and strike that right balance between the different interests of the owner, the sponsor, if you like, and the different sources of finance that they may attract. So, Paul, you talked about risk, as I mentioned before, and in particular, you went through sort of, I think, 4 key points around what helps reduce the risk of a major project, but also match the risk of the project to the appetite of those who are likely to come in and help finance it. But you talked about the importance of definition, getting the what is it we're looking to do, and the narrative around that really important up front. The decision-making structures or governance, as you just explained it, the capability of both the sponsors and the delivery organisations, and then ensuring about value, understand where the value of the project comes from. But through that, I felt the underlying theme that you kept on coming back to was all one around confidence. And what struck me is that when you were talking about confidence, and James, please perhaps reflect as well with your experience, often you were talking about things that you can't put on a scorecard, such as who's leading this, who are the people involved. It was coming down to some personal aspects rather than what's the duration and what are the critical milestones involved in the project. So perhaps you could expand on that in terms of your thoughts around how do we make sure we get the right team and the right people involved in the project to provide that confidence.
Yeah, absolutely. And when we spoke about this last week, it was very much looking at it from the perspective of what can we as a project and program community do to better engage potential finance to make projects and programs more investable. Because I'll go back to the word that you used, Andy. It's about confidence, and investor confidence is absolutely key. That plays out in a number of different ways. One of the ones that you've picked out there is about the level of transparency, openness, and credibility of the team who are actually driving the project. I think one of the concepts that came out last week, which was a very powerful one, again, we'll probably come back to this later in this conversation, is the concept of having somebody who is able to effectively marshal all of the inputs that are coming from the project and all of the inputs that are coming from finance in a kind of a sponsor role. So somebody who can promote the project effectively. But investor confidence, being able to engage potential investors with a powerful story that's been well thought through, knowing where the project or program is going to go, is really, really important, because that's the way that investors will engage with the best projects that are in the market. Again, as you said earlier on, Andy, the UK isn't the only game in town. Investment tends to be quite global in its nature, particularly on a large scale basis, and that means that projects and programs have to compete. They have to put their best foot forward. So I think that aspect of having a clear direction, having strong leadership, being transparent about what your objectives are, and having effectively a well-defined project or program is absolutely key.
I mean, from my perspective on this, I mean, one thing that really came out strongly from the discussion was, and it's an obvious point, that when you're looking at whether projects are investable, you're looking at the project at a very early stage. This is, you know, you're relying on a business case or a feasibility study and a whole series of forecasts, and inevitably there are just unknowns proliferating. I mean, if there's, you know, if it's a transport project which has got revenue attached to it, like HS2 or Crossrail, then you're having to take a view on what future revenues are going to be, and then all the risks inherent. So to me, the two big things are have you got the funding? Because most of the projects that I've seen fail are lack of funding is a big part of, or affordability, to put it another way. But then the other thing is the people who are putting up the money, whether it's state or private, need to have confidence that that project is going to get delivered within the budget, on time, and all the rest of it. And so confidence and affordability are my key points on investability.
Yeah, that's where sort of assurance can help, and the role of the sort of independent assurance to help with that confidence. We briefly discussed sort of parallels to the Hollywood film industry, where they have things like completion insurance, and you know, when I looked at that some years ago, that was very personal in terms of the insurer has things like step-in rights if key milestones aren't met, but they also have a role to play in satisfying themselves that the people appointed to key roles, whether that's the director, the editor, the casting director, and so on, are people that give them confidence that the film will be made on time. And clearly in that context, the completion insurance is all about on time, because it's all about fitting the release into the cinema schedules and the promotion schedules and so on. But obviously their projects are sort of, you know, 15 months, 18 months, and I guess a bit more predictable when they can think about who might be working on it. Whereas in certainly projects where there's a high public aspect to it, with the relevant sort of procurement regulations, we don't know who's going to be doing the work at the point, as you say, early on in the scheme where we're looking for investments. So on reflection, I wasn't quite sure whether that analogy really worked, but it's interesting that one is quite personal in terms of how those insurance schemes work.
But I think one of the problems we have right now is that confidence has taken a battering. And you know, there's been so much, you know, we talk about optimism bias, but optimism bias is an undeveloped concept, but it basically means people are far too optimistic. Risk, you know, lots and lots of projects go over budget and get delayed. And so I think confidence is low. And I think the other thing, we didn't really talk about this, the other thing is risk appetite is probably at an all-time low. If you are trying to parcel out risk, and that's what investors try and do, they try and get rid of as much risk as they possibly can from the equity level, then, you know, the risk appetite down the supply chain is low at the moment, and that's causing some of these projects difficulty, and the sponsors, straight investors in the projects, a lot of difficulty.
Yeah, and there was a really interesting case that was offered of a stadium project. So one that we can't reveal, but the finance package that was put together for it was based on a 25-year repayment, and it was based on very conservative assumptions in terms of ticket revenues, capacity of the stadium, the TV rights that they may get, and so on.
Relegation.
Relegation was a factor there as well, and coming back to that risk appetite, that must have been done where there was quite a low level of confidence in that sporting sector overall. Because then what happened, TV money came in, it even went through the credit crunch, but the project, the stadium was paid off in 10 years, not 25 years. So that low appetite would have meant a much higher cost of borrowing for that project than was really necessary. So there's clearly a sweet spot, isn't there, in terms of being too risk averse or not, to risk taking, and in both of those extremes, you're likely to end up paying more for the project than one that's in that sort of sweet spot that Paul mentioned before, which is matching the market appetite with the risk profile of the project and the solution that the project provides. I'm pleased to say that we're joined by Stewart Westgate. We mentioned that the role of sponsors a moment ago, and Stewart, you provided us with a sponsor's perspective and sort of gave us examples of HS2 and Crossrail and others, mostly transport, but not all transport. But before I sort of come in quickly with a question for you, perhaps you could just introduce yourself. Who are you and where you're from?
Oh, yes, indeed. So Stewart Westgate, I lead infrastructure and transport and cities in BCG, but historically have around 30 years experience delivering major projects and programs. Great.
So, Stewart, we were touching on just a moment ago of the role of the sponsor, and sort of a term that kept on coming up during our discussion was the need for a deal maker. Either someone or a group on behalf of an organisation, because it could be a function, whose principal role it is to, develop the idea for the scheme or the project, package it up structurally in terms of how it's going to be funded, how it's going to be developed, and in a way that then matches the potential source of finance that's available. And Stewart, sorry, James, you were reflecting that perhaps there's not enough of that in your experience from when you were working at Partnerships UK and Infrastructure UK. But we did have a great example from Environment Agency, where there's a team within the Environment Agency specifically set up to go and look for sources of finance to match to the various projects that they've got in their pipeline, in their portfolio. So perhaps we could just have a sort of the remaining time on this discussion about that critical role of the deal maker, and what sort of capabilities are needed. Do we need to start developing different people in the major project sector now, so that we've got the deal makers in 5 years, or do we need them? Do we need them now? Who would like to come in on that?
Well, if I just kick off to say, I think we should recognise that the role of sponsor is now a very mature and well, I think, appreciated role in the major projects world. And it wasn't always thus, but certainly over the last 20 years, it's become more prominent. And in the market, we see the role carried out in a number of different ways, in particularly rules-based cultures, national safety asset owners with significant safety profiles. The sponsor role is quite prescriptive. There's a particular workflow and a role for interventions and definitions. But in many other organisations, it's a much more free-ranging role where the sponsor has quite a creative perspective in how to realise benefits, look along the broadest range of options, not only in terms of the solution design, but indeed, the topic we're discussing today, how to bring investment, how to bring funding. And I think there are some really interesting examples, and if you look at in deep history, the construction of the Channel Tunnel rail link, the creation of funding through the King's Cross lands, and then subsequently in Thameslink, where we saw quite considerable sponsor intervention when time and cost were becoming unacceptable. under the original terms of the project. There were innovative ways of bringing that kind of either phasing of the project to deliver benefits in a way that would suit the needs of the customer, but not break the bank in terms of funding envelope. In the case of CTRL, really leverage private sector investment in order to firstly deliver the transport solution, and then exploit the development of property around that. And I think we're increasingly seeing that. And more recently in Crossrail, I think there were some very strong examples, particularly Canary Wharf Station and Woolwich, where we saw private sector, in that case, developer on the one hand, construction company on the other, bringing a construction solution for the core project, but also exploiting that to the benefit of their business interests in terms of creating residential and commercialization opportunity. And then very recently, the thus not launched, but the development of Crossrail 2, which had a huge dependence on line of route land value uplift and property development, again by bringing a number of other parties through a very proactive sponsorship approach to bring extra value to those investments, make a stronger case for those investments, if you like.
Great, and I think you gave an example of Euston Station more recently as well, in terms of it was the government that effectively became the deal maker there.
Yeah. Yes, indeed. I think Euston is a particularly good example because government, I think, informed by private sector insights, realised that the best way of truly realising the potential value of that massive investment as the southern terminus of the high-speed 2 rail link was to engage private sector development, creative thinking, by coming up with the seed funding of the development, so the foundations and the area development costs, in order to not prohibit the subsequent development by commercial parties. And Treasury in that case invested several £100 million and engaged private sector project specialists who are still in play there to make sure that the construction of the project didn't prohibit that development, but furthermore created the necessary foundations, lift pits and facilities that the future development could truly exploit, which all too often, if not done properly, ends up being locked out, and therefore it does inhibit future development.
Yeah, I mean, I think there are two big market factors playing into this. One is, as Andy, you said, one of my points was that we don't have a large domestic sponsor. So that tends to mean we have multiple sponsors on the private sector side. And secondly, that the state is taking a much larger part in a lot of projects in the UK. And Stuart's example of Euston is a great example of that. And when you've got multi-stakeholders in a project, you need a deal maker. You need someone who is going to drive the deal to a conclusion, facilitate agreements, because what tends to happen is that everyone just looks at everybody else to take risk, and delay ensues. And government is particularly bad at this, in my view, and because often there are multiple bits of government involved in these deals, whether it be the sponsoring department. We've now got the UK Infrastructure Bank providing finance. The Treasury is always lingering in the background of all these deals. So as well as being a deal maker for the deal as a whole, there probably needs to be a deal maker for the public sector contribution to the deal as well. And I just think there's an absence of deal makers. If you look at corporate finance, the top corporate financiers are deal makers it's a different market, but that's what they do. That's what they get. That's what they get paid the big bucks to do.
Yeah, and actually, James, you mentioned that in your intro on the day about the difference between the corporate finance and the project finance. And so do we need more of those corporate finance skill sets into the project finance community, or just the approaches?
Well, the context I mentioned that was we had an interesting discussion on the day about, small deal, does size matter in when we're talking about investability of projects? And I think the conclusion we came to was it does matter. And that if you're at the small end, you have to reduce complexity because the fixed cost of complexity in a small deal is just overwhelming. And one solution to removing complexity is to bring in what I call a corporate finance solution, where you make no distinction between layers of equity and debt, and you just have one financial package that has a weighted average cost of capital. And that is a market that never developed in the UK. It has actually developed in some international markets, but you know, we never saw sponsors and just saying, well, finance deals off our balance sheet to get them done, and then they could have refinanced them at a later stage. That model just never happened, and I thought it was a great shame.
I think the other aspect of this this role that we're kind of developing in the conversation is very much about somebody who can effectively own and manage a common understanding of risk, or a common language that's applied to risk, because quite often you'll find that the project and the investor can take a different view or use different terminology to describe risk. So I think somebody sitting in that role who is able to bring together the different aspects of risk and create that common understanding is very important. Again, it comes back to investors having confidence, understanding what's going on, and there being transparency. So it is a very important role from that perspective as well.
And we had a great example of deal makers from the Environment Agency. We had Richard Bowen and Paul Wise, and they gave a number of examples of how they were looking for additional contributors to their projects in any way, even in kind. They gave an example of a beneficiary of one of their flood defence schemes being an employer in the area, and it was a law firm, and so they provided legal advice to the project and drawing up the various agreements that were needed. But one that caught my eye was the project at Catterick that they mentioned, where there was a flood scheme that they wanted to do that had affordability issues in itself, and they were struggling to meet their own sort of internal rules for securing the finance for it. And then there was an adjacent project that National Highways were doing, and they couldn't quite make that viable as well. But when you put the two together, jointly they became viable. So you could make it one single project that had some common aspects, and then they were able to secure or make that project investable and secure the finance that they needed from both their organisations and some additional contributors. And it feels that we need more of those, or more of that thinking. And I was relating it at the time to a report that the National Audit Office released earlier in the year around the progress to net zero, the 2050 net zero progress. And one of their recommendations, both a criticism and a recommendation, was the need to join up opportunities between different government departments, because we won't meet our 2050 net zero commitments if we do them on a siloed basis individually. We need to start doing some joined up work across different aspects of government and across the wider public sector. So that's tough though, isn't it? Because the way that our organisations are set up naturally makes them focusing on their own objectives and mission, rather than looking outside to see what else is coming along. So these deal makers, it seems to me, and it'd be interesting to get your perspectives, that sort of collaborative leadership, entrepreneurism is a critical trait that these deal makers need. Have you got any thoughts on that? So I can see you're nodding, James. Oh, you're muted, James.
That's because my dog was barking, for which apologies. No, I think you highlight a very important point that unfortunately the government is very siloed when it comes to risk taking. I mean, that's different. You can't. There's no concept of shared financial risk in the public sector. It has to be on somebody's accounting officer account, and that makes life difficult. My personal view is, if I look at the landscape within government, I think the National Infrastructure Bank has the capability to be a deal maker. I don't think that's where it's positioned. I think what we heard from Steve is I don't think that's where it's positioned at the moment. I think it's positioned as an organisation that can invest equity, debt, and provide guarantees. But I haven't seen anything that says to me it's going to be this deal maker. And a deal maker doesn't necessarily need to be the principal risk taker or the principal sponsor. The deal maker's role is to bring the parties together and thrash out a deal, to facilitate. It's a, I've been called a fixer in my past life, and there's an element, it could be fixer, deal maker, whatever you want to call it. But as I said, I've just seen so many projects get delayed, particularly where the public sector is involved, because of the absence of a deal maker, and the public sector sitting back to see what risk other people are going to take. Now, I'm not blaming the public sector because it's very difficult. There are very few incentives in the public sector to take risk, because there's so many checks and balances that come down on you from post review, retrospective reviews, that and you don't get rewarded for success. You just get penalised for failure, which causes a problem in the public sector when it comes to. That is why Richard and Paul from the Environment Agency were so impressive. I mean, I was so impressed by their entrepreneurship. I mean, I actually said, if you remember, I said, if you want to sell ice to Eskimos, here's two guys who can do it for you. But that they were putting these deals together. I think 20% of their money for any flood relief scheme comes from the private sector. And when we say the private sector, this is coming from everyone from local developers to cement manufacturers to lawyers providing pro bono resource. They just get everywhere to make these deals happen.
Yeah, and it sort of opens opportunities for us to consider, other organisations playing a part in deal making. So in a recent seminar, we looked at the HyNet Northwest, the hydrogen network that's being developed looking at it from a systems perspective, so a system within system. But within there's an organisation called Progressive Energy, which is like the advocate for the scheme, and they are, in a sense, what we're talking about, the deal maker. They're not the organisation where the funds will flow into or the finance will go to, but they're working with the regulators and others to broker arrangements to increase the confidence overall in that scheme, so that it will attract others in. And I guess it was similar to what we heard from Steve Lomas from the UK Infrastructure Bank, where part of their rationale is to crowd in rather than to crowd out. And if they are associated with an opportunity, then we talked earlier, Paul, about confidence, then the presence of UK Infrastructure Bank will increase the confidence of others to come in. As always, these podcast recordings, the time rushes past, and we're rapidly coming to the end of the time that we have allocated. And we know that from feedback that our sort of members and listeners really value these podcasts, but we do try to make them nice and short so that they don't go on for too long. So that's a roundabout way of saying that we need to wrap up this podcast. So I'll go to each of you and perhaps ask if you could just offer a top tip in terms of anyone working on a new scheme or that's seeking finance for a project. What's your top tip in terms of improving the investment appeal for their project? So I'll start with Stuart first, then Paul, then James.
Yeah, my parting shot is that while absolutely the role of sponsor is increasingly becoming that of deal maker, actually that doesn't mean that they have to be an expert in all the ins and outs of financial modelling and contract law and all those other things. Really, it's about identifying which potential partners have aligned interests and can bring something to the party and an overall interest in the outcome. And if you can do that, you're 90% of the way there. And so I think that's everyone can be the deal maker in that context.
Brilliant. Thank you, Stuart. Paul.
Thanks, Andy. My parting shot is about projects and programs being credible and being able to engage confidence from potential sponsors, potential investors, and how important that is from the outset, as we discussed earlier on, actually having a credible plan. Final point is, and to a certain extent it revolves around this concept of a sponsor or promoter or whatever the term is that we end up with. The the credibility of the individual who is in that role. Successful large-scale projects and programs that tie together a lot of different threads will generally rely on the quality of that individual at the helm. So it is a very distinct role that's emerging that can add quite significant value to bringing successful projects together.
Great, thank you, Paul. And James, lastly to you.
Yeah, I would endorse that last point of Paul's. You know, the correlation between good projects and good leaders is absolute, and bad projects and bad leaders. So yeah, the one thing we haven't talked about is data, which we did talk about on the day. And I do think that the more evidence and data you can produce at the early stage of a project to build confidence in what you're trying to do, the better. Now that one of the things we noted on the day was that for some of these particularly large public sector projects, they are first of a kind. You know, there's no, so that can be quite challenging. But as I said, if you can produce good data, good information, that will increase confidence.
Yeah, we sort of saw that firsthand with the power of modelling to show impacts of different weather events on the flood projects that Environment Agency were looking at. Yeah, it feels that we could have a whole new seminar another day on the challenge of first of a kind major projects, and you know, I've got lots of ideas running away in my mind now. One last thing that we did discuss on the day that we've not really followed up on this one, because we address it many times elsewhere, it is around environmental factors, and I mentioned it right at the beginning around the sort of green finance, and we know that, you know, ESG, environmental, social and governance factors are critical in terms of the funds that are available out there, and we know that from the work that we do with our sustainability landmark objective, that environmentally sound projects do not need to cost more, and they increase their appeal at the same time. So I think that'll be my top tip, if I'm allowed to add one as host, which is think of the environmental sustainability first, and it will enhance, not hinder the project's investment appeal. So with that last thought, I will bring this podcast to a close. For those of you who are regular listeners will know that there's a highlights report that accompanies the seminar that should already be published, and then shortly we will produce the full transcript of all of the discussions and debates and presentations that were held on the day. So please do visit our website and look out for that one, and also you'll see our upcoming seminars. So thank you for listening.